SpaceX just closed its first trading day at $160.95, up 19% from the IPO price. $75 billion raised, the largest public offering in the history of financial markets. And right now, millions of people are watching that number and feeling one thing: fear of missing out. Marcus is one of them. Marcus. Priya, it ran 19% on day one. That thing is going to $300. I'm buying tomorrow morning. Priya. Marcus. Sit down. I need to show you a document. Marcus. What document? The stock went up. Priya. The prospectus. The one SpaceX filed with the SEC. 150 pages. Most people buying this stock have never opened page 1. Here is what this video is and what it is not. This is not a video about whether SpaceX is a great company. By almost every measure, it is extraordinary. Starlink has 10.3 million paying subscribers across more than 150 countries. The rocket launch business has no real competitor at scale. The defense contract pipeline runs deep. Nobody is arguing the rockets. What we are arguing is this: a great company and a great investment on day 2 are not the same thing. And the gap between them is where ordinary investors quietly lose money while insiders quietly get rich. There is a clock running right now that almost nobody buying SPCX today is tracking. It is printed in the prospectus. It is completely public. And by the end of this video, you will understand exactly what it says. Before we touch the clock, you need to understand what you are actually paying at $160. SpaceX generated $18.67 billion in revenue in 2025. At the $1.75 trillion IPO valuation, that is roughly 94 times annual revenue. At the price SPCX closed on day 1, the valuation crossed $2 trillion. You are now paying closer to 107 times last year's revenue. For a company that is currently losing money, the combined net loss in 2025 was $4.94 billion. In just the first quarter of 2026, the company burned another $4.28 billion. Marcus. Okay, but it's SpaceX. You pay a premium for the future. Priya. Sure. But how much premium? Morningstar, one of the most respected independent research firms on Wall Street, ran a detailed valuation and put the fair value at $700 to $80 billion. That is more than 55% below where the stock went public. Not a blogger, not a Reddit post, a credentialed firm with a formal model. Marcus. Analysts are wrong all the time. Priya. They are, but here is the question you should be asking. If a serious independent analyst says $780 billion and you are paying $2 trillion, who has to be right for you to make money from here? Let that sit for a second, because the rest of this video is about something sitting on top of that. When SPCX opened for trading on June 12th, only about 5% of the company was actually available to the public. Think about what that means. 555 million shares were sold, but SpaceX has roughly 13 billion shares outstanding in total. The other 95% is sitting with people who got there first. Early employees. Venture firms like Andreessen Horowitz, Sequoia, Founders Fund, and Valor Equity Partners, some sitting on paper gains exceeding $60 billion. These shareholders are not allowed to sell yet. They are locked up by a contractual agreement. Marcus. That's normal for any IPO though. They always have a lockup. Priya. You're right. It's normal. What is not normal is how this particular lockup is structured. Most big IPOs use what is called a cliff. One date, 180 days after listing, all restrictions lift, insiders can sell. Rivian did it that way. Uber did it that way. One date, one wave of supply, one very bad day for anyone who did not see it coming. SpaceX did something different. And whether that is better or worse for you depends entirely on which side of the calendar you are on. Pull out a calendar. Today is June 13th, 2026. Here's what the next 6 months actually look like, pulled directly from the S1 prospectus. Day 70, August 21st. The first of 5 time-based tranches unlocks. Up to 7% of eligible insider shares become available for sale. Day 90, September 10th. Second tranche. Another 7%. Day 105, September 25th. Third tranche. Another 7%. Day 120, October 10th. Fourth tranche. Another 7%. Day 135, October 25th. Fifth tranche. Another 7%. 5 tranches. 7% each. That is 35% of insider shares releasing between late August and late October, but those are just the time-based unlocks. Two earnings-linked cliffs sit on top of them. 2 days after SpaceX reports earnings for the quarter ending June 30th, which can land anywhere from mid-July to late September. 20% of eligible insider shares unlock, not 7%, 20%. That is a bigger single event than any of the 5 tranches combined. 2 days after the September 30th earnings report, expected somewhere between mid-October and December, another 28% unlocks, and sitting above all of it is the performance trigger. If SPCX trades at least 30% above its IPO price during 5 of any 10 trading days in the window around the Q2 earnings release, an additional 10% of insider shares unlocks early on top of the Q2 cliff. The IPO price was $135. 30% above that is $175.50. Marcus. Wait, the stock hit $176.52 on day 1. That is already above the trigger level. Priya, exactly. The trigger threshold was nearly breached on the very first day of trading, which means this is not theoretical. One sustained week above $175 and that extra 10% unlocks alongside the Q2 cliff. Now add the math. 35% from the 5 tranches, plus 20% from the Q2 earnings cliff, plus 28% from the Q3 earnings cliff. That is 83% of eligible insider shares released before the standard 180-day expiration even arrives. The remaining 17% lifts on December 9th. Marcus. So by December, everything is unlocked. Priya. Everything except one person. Elon Musk holds approximately 42% of SpaceX's equity and controls around 85% of its voting power. He agreed to a 366-day lockup. He cannot sell a single share until June 13th, 2027. Every headline called that a confidence signal, and it is on its face. But here is the part those headlines skipped. Every other insider, the early employees, the venture firms with tens of billions in paper gains, the executives below the very top tier, they all follow the schedule we just walked through. Their first window opens as early as mid-July when Q2 earnings land. By the time Musk's lockup begins to lift a year from now, everyone else will have had 12 months of structured exit windows to sell into retail demand. Marcus. So Musk staying locked up actually protects the other insiders more than it protects us. Priya. Think about it this way. Musk does not need liquidity. His net worth is not tied to selling SpaceX shares. A public lockup costs him almost nothing and signals confidence. The venture firms and early employees have fund timelines and clients waiting on returns. They need to convert paper gains into actual money. The structure gives them the runway to do exactly that. The person buying SPCX on their phone right now is the demand those exit windows are pointed at. Marcus. Okay, but those are just dates. How bad does it actually get? The history is uncomfortable. Palantir went public in September to 2020. Retail enthusiasm pushed the stock from around $10 to near $40 by early 2021. Then the lockup window opened. Insiders, including Peter Thiel, sold tens of millions of shares into that premium. The stock fell 13% in a single session. Rivian went public in November 2021. 6 months later, the lockup expired. News broke that Ford would sell its stake. The stock dropped roughly 17% in one day and lost more than 67% from its peak over the following year. Uber went public in May 2019 at $45 a share. By November of that year, when the lockup expired, the stock sat about 40% below the IPO price on the very day insiders were first allowed to sell. Even Snowflake, which used a staggered schedule, the closest model to what SpaceX is doing, still dropped approximately 11% across its final expiration week. Priya. None of those were bad companies. Most are still operating. Some eventually recovered. The point is not that SpaceX crashes. The point is that the part of the deal that hurt retail investors in every one of those names is still ahead of us in this one. And SpaceX is going public at a higher revenue multiple than any of them. Now, and this matters, there is a real argument on the other side. The staggered schedule genuinely is better than a cliff. Instead of one violent supply shock at 180 days, the structure spreads selling across a dozen smaller windows. That is a real improvement compared to Rivian-style expiration days. Additionally, some of the largest institutional holders quietly sold portions of their SpaceX positions in private secondary markets before the IPO ever happened. That means some of the selling pressure that would otherwise concentrate at lockup expiration has already been absorbed before retail investors were ever involved. And the NASDAQ 100 fast entry rule, which allows SpaceX to join the index as early as 15 trading days after listing, means a wave of forced buying from index tracking funds will pour into SPCX in the coming weeks. That buying pressure is real and it is mechanical. Marcus. So there are actually reasons the stock could keep running. Priya. There are, but here's the catch. If the performance trigger fires, the NASDAQ buying floods in, and the stock sustains above $175 for a week, that extra 10% of insider supply unlocks early alongside the Q2 earnings cliff. The buying pressure and the new supply arrive in the same window. That is not necessarily a disaster, it is just something you should know before you buy. So where does this leave you? There are 3 paths. The first, chase the hype. Buy now, ride the NASDAQ inclusion wave, and hope you exit before the Q2 earnings cliff in July. You are timing the market. That is a trade, not an investment, and most retail investors lose at that game. The second, write off SpaceX entirely because the deal structure feels unfair on day one. You might walk away from a generational company over a bad entry point. The third path costs you nothing but patience. By mid-December, every tranche will have unlocked. 2 full earnings reports will be on record. Real revenue, real margin data, real guidance. The NASDAQ forced buying will have run its course. The performance trigger will have fired or not. 6 months of reality will have replaced 6 hours of hype. Marcus. Mark 4 dates. Priya. Mid-July to late September. Q2 earnings. Watch what unlocks and whether the performance trigger fired. Late August through late October, the 5 staggered tranches releasing 7% at a time. Mid-October to December, Q3 earnings and the 28% cliff. December 9th, the last restriction lifts. After that, you are looking at a price shaped by 6 months of actual business results instead of 1 afternoon of opening day momentum. Marcus, Amazon, Google, Apple, none of them required you to own them on day 1 to do extraordinarily well. Priya, the market rewards patience far more reliably than it rewards urgency. The number on your screen today is loud and it is green and it is pulling hard. The calendar is quiet. It does not pull, it just waits. And the people who engineered this deal, the bankers, the venture firms, the executives who wrote every clause in that prospectus, they are reading the calendar. You should too. If this breakdown helped you think about SpaceX differently, subscribe. Every video we make uses the same lens, the mechanics behind the deal, not just the price on the screen. The next big IPO is already filing. We will be ready before the headlines are.